Welcome everyone. In today's video, we're going to be discussing price delivery. Now, price delivery has everything to do with how orders are being executed, how liquidity is being interacted with, and how the market goes from one price to another, and more specifically, the nature in which it does so. Now, a lot of people have the misconception that price delivery is governed by some omnipotent, malicious algorithm which is going out hunting retail stops and actively trying to take people out of positions with negative intent, which is completely false and a flawed way of thinking. Now, if that is the way you think, I want you to go into this video with an open mind, kind of put your previous knowledge to the side for a minute and take in a new understanding of the market. You must understand that the use case of FX is so wide, and not everyone is sitting behind their desks and speculating on price how we are, as we'll see very shortly. There are a wide range, a multiplicity of clients that or participants and entities that are using FX for many different reasons, and very few of them are here with speculative intent. So just take a step back for a minute and try and recalibrate here while I walk you through, first and foremost, the kind of structure of the FX market to kind of give you an insight to the much larger use case, and make you realize that this is not just all about you and what you see on your chart, because it can be very easy to get kind of your vision clouded by all these candlesticks and think that, it seems like price is so very well, pushed around into these key areas. And there's a reason why it does this, but it's not, for retail stops and things like this, right? And it's not to harm anyone. And you also have to remember that most of these institutions that do have market moving potential aren't looking at candlestick charts how we are, right? So just bear that in mind. So the first thing I want to start off examining here is the kind of structure of the FX market, right? So as I'm sure a lot of you know, the FX space is a decentralized market where there's no single there's no concentrated or single exchange where transactions occur. It's actually fragmented over multiple different venues, and this gives us a very unique structure to the market. And as you can see here, we have this kind of line which represent what we call private banks, or prime brokerages, right? Mainly, we want to be understanding that there are a small group of individuals, and I say small group, it's not really that small, but there are a group of individuals who are on the sell side of the market. And we're not talking about sell side liquidity or buy side liquidity here. We're talking about participants and entities who are providing liquidity to the market. These are the entities that are on the sell side of the market, and anyone that is using that liquidity and taking up that liquidity is on the buy side of the market. So in this case, these prime brokers and these dealers would be on the sell side of the market, and the clients, these circles with the letter C are the clients, and these clients are very diverse. They can go from private individuals to corporations, to central banks, to investment funds. There's a wide range of clients that will be operating through the bank. Now, what we must understand is that these individuals, when they set up with one bank, what prime brokerage allows is for the one client to access one bank's credit lines. So as you can see here, if you was to have, your account set up with one bank's liquidity, you would only get access to, let's say, this quote right here, which is the quote from that one bank. And in fact, before we touch on this, I want to read you a quote from a document that was issued out by HSBC, right? Just to kind of back what we're saying here. You see here it says that where a client places an order for execution using a particular algorithm, if the algorithm so permits, at the client's direction, HSBC will execute such an order against, number one, liquidity that HSBC accesses by way of transactions with third parties, and or number two, the trading inventory of HSBC itself, right? So in this case, the prime brokerage or the dealer would be HSBC. Now, HSBC would have its own inventory of liquidity that it can provide to its clients, right? And if it wants to do so, and there'll be some cases where it will, or some cases where it won't, it can provide that liquidity to the market, and it can provide a quote to the client, and it can provide a quote to the client. And if the client isn't set up with prime brokerage, it will usually only just have access to that client's to that prime broker's liquidity or that dealer's liquidity. Now, what prime brokerage allows is for this client to have access to this bank's credit lines. And what that means is that, number one, all these banks, right, and usually it's in the interbank market, they will all be, and all the dealers will be in communication with one another, and they will all have credit lines with each other, and they can borrow and lend to each other, and the client will then have access to this. And they will also have access to the aggregated feed. And what the aggregated feed is that each individual liquidity provider will be streaming a quote, which again looks like this, from an individual provider. Each one of these banks will send out a quote into the aggregated feed, like CurrentX or FXall or Integral. Right, they'll send these out into these feeds, and it's not just one aggregated feed. There'll be multiple due to the fragmented nature of FX, and these feeds will aggregate those prices into a structured book, right? And that creates a depth of liquidity. Instead of just having this one quote right here, you now get competitive pricing where you're going to get better bids and better offers. So that's what that aggregated feed does, and it allows the client to access a deeper pool of liquidity. Now, again, when we're talking about the clients that are operating here, we're talking maybe, there might be a corporation that wants to hedge some exposure through options or through FX options or futures. There may be a private individual that wants to just do a normal FX transaction from euros or pounds to dollars to facilitate a real estate purchase overseas, right? There's a wide variety of reasons why clients want to be accessing the bank's liquidity. It's not just, as we mentioned, speculators that are sitting there with, you have to understand that there is some kind of speculative component behind some of these decisions, but they don't really care about where price is going to end up in the next days, weeks, months, or even years, right? It's not the case. That's not their main purpose for the transaction. Right, so that aggregated feed is what we call the global feed, and this will be provided to the clients. And then what happens, and this is how the price ends up on your screen, is that will be sent out to a retail broker. The retail broker will repackage that feed by either adding on a markup, or adding on a commission, and then providing that to you. So that's kind of the structure we are working with. So you can see that where you end up right here, right, is a very small section, a very small corner of the marketplace. And there's a lot more complicated things that are going on over here, right? Now, you and me, or retail FX, in the way that we trade, makes up less than 1% of the global daily turnover in FX. Whatever these larger institutions need to fill, we don't provide the liquidity that's required for that. We are not targeted in the marketplace. There's no target on our backs. And the reason why you need to understand this is because it takes you away from a victim mentality in trading. You step away from believing that price is targeting your stops and all these things, and you realize that this is just a function of how price works. Price or the marketplace operates, and the way that a lot of these institutions operate, especially the algorithms that are employed within these prime brokerages, are operating in a way where they want to fill orders in the most efficient way possible, in terms of causing minimal price impact and also or price movement, and also being done at the lowest cost possible. Right? They're not trying to do things to manipulate, not on a large scale anyway, to manipulate others or retail trade. It doesn't exist, right? Normally what you'll see happening here is some form of either accumulation of inventory, right, to be able to provide liquidity. So if they are anticipating a demand for euros in the near future, they will begin to acquire euros to begin to build up inventory so that they can then hedge that off. And again, HSBC document, we can confirm this, right? As part of HSBC's management of client activity, HSBC trading personnel may seek to anticipate near-term client demand and take positions in connection with its risk management activities. In such cases, HSBC's actions are intended to provide it with sufficient inventory to service its clients, right? And if it also takes on too much inventory or it depletes its inventory too much after providing liquidity, it will need to rebalance that in certain scenarios. And this can also cause price fluctuations. But again, understand that the use case of FX it goes way beyond how you and me transact in the markets. But to take a look at what's kind of going on this scale, a order will be placed into the bank by the client. The bank will then decide how it wants to deal with this. If it's a large order, it will be broken down into multiple child orders, sent through multiple venues, and then the operation is to get a large order filled in an efficient manner. And the reason I'm saying this is because it comes back into the conversation at a later time. So now that we've analyzed, the broader space here, and we understand that, this feed that we get on these exchanges isn't, provided by one overarching entity, and it's a result of a multitude of different participants, and it moves due to supply and demand and changes in the states of liquidity and the interaction between aggressive orders and passive orders. Now that we understand this, we know that there's no malicious intent behind these price moves, we can begin to look at the more or the areas of price delivery that we are concerned with. Let me just bring this back a bit to here. Right. And when it comes to price delivery, the two main states that we are focusing on, right? So number one is inefficient delivery. And the other end is efficient delivery. Right. And now price will, these are two extremes. You have extremely efficient and extremely inefficient, but price will be able to manifest anywhere on this spectrum. Right. And this is just something you have to be comfortable with, that an area will either be more efficient or inefficient than a previous area, and it's always compared to another area. You can't just, it's very difficult to just call one type of price behavior efficient and another inefficient, because price materializes in a whole bunch of variations, right? And you have to be able to read when price is relatively efficient and when it's relatively inefficient. So like I said, price can manifest, or price delivery can manifest anywhere on this spectrum of efficiency and inefficiency as such. So let's get rid of this and start to look at how we can begin to understand the characteristics of each phase of delivery. So the area that we have marked out here is what we would call efficient delivery, right? And the characteristics of efficient delivery are congested PA, kind of sideways PA, where price is range bound, where there's neither buyers or sellers taking control of the market and pushing price out of this range. And the flows that are coming into the market tend to be relatively stable. We call this a transactable environment, and it's mainly because it's a self-fulfilling cycle, right? Where the market begins to become liquid, where there's more dealers and market makers providing liquidity to the market, it attracts more customers. More customers attract more liquidity providers. And like I said, it becomes a transactable environment where, number one, market makers and dealers who are making a profit from quoting a bid and an ask, right? This is where they make the majority of their money in these environments, because price is relatively stable, and in stable conditions, that's where they can provide a bid and an offer and quickly buy and sell, and make money from the bid and the offer, the spread between the two. If price is too volatile, they begin to pull that liquidity away, and they're a bit more risk off, because in more volatile conditions, they can get clipped as price breaks out in one direction or another. They can very easily end up in a loss, that they don't want to be in. So in these stable conditions, in these relatively stable conditions, these market makers and dealers tend to be more active, and that the higher activity and that more liquidity that's being provided to the market allows for larger orders to be processed into the market, and you get an accumulation of volume and inventory and all these things. There's a large amount of transactions that occur in these regions. Now, what we have to understand is that liquidity isn't static. It's dynamic. It's always changing, and adapting to market environment, to economic environments, and on a tick by tick basis, the state of liquidity is changing, not just at the market, but at these pools of liquidity that are further away from price as well. So what we want to understand is that at this area here, at the start of this consolidation, at the start of this stability, liquidity tends to be a bit thicker in the book, right? There tends to be a bit more liquidity being provided on either side of the market. But the longer price consolidates, the more we see activity begin to decline. And I can get this up for you right here. Right, you can see that the longer price stays in this state, let's say this is where we put in the high, this is where we put in the low, and we range between those. Look how day on day the volume declines and declines, and this as trade activity declines, right? You have to understand it's what we said before, where it's a self-fulfilling cycle, where the more activity there is, the more liquidity providers there will be, which usually drives more activity, and it works the same the opposite way around. When there's less clients, less liquidity is being provided to the market, because again, they make money. These dealers and these market makers make money by quickly transacting between bids and asks, right? Or quickly buying a specific amount of a currency and selling it off in quick fashion. If there's not many clients available and participants available in the market, then there's no business to do. So understand that when we see this decrease in activity, right, and this decrease in volume and tick frequency, we then tend to see liquidity dying out of the market as well, and moving away from this area and pooling at areas where price is deemed as cheap or expensive, right? Areas such as here. Let's get rid of this for now. And areas such as, these arrays, you've got this distal line down here. If we was to, go a bit further than we need to now, if we get this, you can see that this array lands in our discounted region of our chart, right? This down here. And that's where liquidity will begin to pool in more expensive and cheaper areas on our chart. So this area gets depleted of liquidity. So even though it's efficient, right, in nature, at some point liquidity will fall off, and this dropping off of liquidity will spur inefficiency or create an environment that will make price more subject to an illiquid move or inefficiencies, right? Now, let's go back to what we were speaking about in terms of the order book, right? So at the start of this kind of consolidation period, the book will tend to be quite thick and, like we said, transactable. The state of the market will be transactable. There'll be more liquidity providers present, and there'll be more absorbing power in the market. You have to think of liquidity as absorbing power. The more liquidity there is, the more market orders can be absorbed, and the harder it is to move price. But then the less liquidity there is, the less absorbing power there is in the market, and the easier it is to move price over certain levels. So at the start, right, of this consolidation, we could say that liquidity was thicker, right? And there was more active providers on the book. And let's say each of these lines represent 5 million units of currency. Now, if we wanted to, if a large order was pushed through the book, right? Let's say a large order came into the market and it got broken down into its chunks, into its child orders, and starts to get pushed through. It may start to work price. It may start to work price, and then let's say it gets pushed out to seek liquidity. In this case, it could let's say a large order for, let's call it 10 million, right? Each of these levels of 5 million. If the order for 10 million sell comes in, price would have to move down 1 liquidity level and then 2 to seek that opposing liquidity, right? We need to fill 10 million units, price seeks that down here, and we get this price move down, right? Now let's imagine in a more illiquid scenario, right? And this is the case over here, right? Where price becomes more illiquid. Right? Now the same size order, let's call it 10 million units, comes in, right? And let's say again, let's say this drops down to 3 million units there and 2 million units there. So there's less liquidity on the whole, and there's less liquidity being quoted at each price level. If 10 million units comes in to be sold now, we have to seek that liquidity. We find 3 here and 2 here, right? So price has only filled half the order, and we've already moved a lot more than the previous move. So notice how an illiquid state makes price more subject to volatility and to a price run, a move where we have to seek liquidity now because there isn't enough available in the book, right? So we have to begin to seek liquidity, and that usually gets sought out at liquidity pools where these incoming orders can be absorbed at, where there's potential, right? So let's get rid of this. Let's get rid of this. And this leads us into the next state of delivery, which is inefficiency. So now that we understand that the longer price spends in this range and this transactable period and this efficient period where little arrays are being created, and it's more of an accumulation phase of where a bulk of transactions are occurring, and I can quickly display this to you, right? If you look at, this price move from this low to this high and then extend this over here, we can already see that where price ticked through the most, again, that tends to be where the majority of the transactions occurred, was over here, right? So you'll see a bulk of volume existing in this, in line with this box over here, exactly like so, right? Where price spends the most time, where those body closes are concentrated, tends to be where volume is concentrated, right? And you can see in this area here where price ran through inefficiently, which we're getting onto, there was very little transactions and very little tick volume and tick frequency. So understand that the longer we spend in this range, the more activity will die out, right? So there was a lot of transactions occurring here, but these begin to die out. And as activity begins to die out, liquidity begins to dry up, and liquidity will begin to pool away from the market area and at these arrays and at these areas which are considered cheap or relatively cheap and relatively expensive, right? And this creates a thin environment in the book. Now understand that for a illiquid environment to occur, there has to be a large order hitting the market relative to the state of liquidity, right? Price movement is a function of available liquidity. Keep that in the back of your mind. So if there isn't enough liquidity to fill an order, then price will usually have to start to seek liquidity, and in the right condition, in an illiquid state, which we have discussed here, it will tend to have to run out of this range and seek liquidity at external regions, and these tends to be areas on our charts where price is considered cheap or expensive. So now we want to dive in a bit more to the mechanism that kicks in when price begins liquidity seeking. So, and this can be triggered by, one venue or one institution pushing through an order, right? What will happen is that you'll get a large order hitting on a weak pocket in the book, right? Hitting on a weak side of the book, and this will trigger a volatile move outside of this range. So we already established that the state of liquidity is very low here, right? Then what will happen is that as this large order starts to come through in this low liquidity environment, let's just build up a stack of bids here, right? As this large order starts to hit on a weak side of the book, the algorithm that is providing liquidity in all the banks and in these venues will flag this event, right? This large order coming through in this specific environment, and if it's saying cool, price is highly likely to be pushed lower into the bid side of the market, seeking liquidity on the bid side very violently and in a volatile fashion, then we don't want to get clipped, and we're going to protect our liquidity by pulling it away or by decreasing the amount of liquidity we're providing on this side of the market. So as this order starts to come through, let's try and create a good example here. Right, so as that starts to trigger, they will start to pull this bid side liquidity away, right, creating an even thinner market condition, right, and then price enters a state where it needs to start seeking like that, and we start seeking liquidity. But as it's moving, they keep pulling these orders away and making the bid side of the market even thinner than it already is, and it becomes this kind of chasing mechanism where price needs to keep seeking and seeking and seeking, and the orders that were initiated here can't get filled there. And you have to understand there's also a time priority that gets implemented in these venues, where there becomes a backlog of orders that wanted to get filled at market, right, or that want to get filled at price, and there'll be times organized. So the ones that got there first will get filled first, and then everything that came in after would be put in on the backlog, and price drags up, and drags these market orders up with it, or in this case down, drags price the market orders down with it, and needs to fill these orders at the next available pool of liquidity. All right, quick interruption, guys. I just wanted to highlight another aspect or another mechanism that kicks in during these moves, which again make the market even more illiquid. We have to understand that the mechanisms or the strategies, so to speak, that the algorithms are applying in these scenarios are all in the name of risk protection, right? They are changing the way they are providing liquidity so that they're not getting in unfavorable situations. So I want to refer to this HSBC document again, where they talk about last look, right? And last look pricing is when, hold on, let me just get this up here. So, price, last look is when they will do validity checks, and price checks. And the price check is where a client submits a trade request to HSBC. And it's possible that HSBC may have refreshed its pricing independent of and prior to receiving the trade request. And where this is the case, the price checks ascertain whether or not the client's trade request is within a predefined price tolerance for execution. So what it means is that in certain scenarios, and in these volatile moves where they may have provided a quote to a client and the client tries to execute on it, the client will, the bank will employ last look, where they will have one last look at whether, the rate they're providing is, one that is unfavorable, and if it is, they will then reject the quote and provide another one, or just reject it in total and prevent the client from trading in that particular case. So I just wanted to make that clear, and hope you understand that these strategies that are being employed are all depleting the amount of liquidity available in the market during this move. Now, in this case, you can see that this area acted as a liquidity base, right, and it's better on the 1 hour, right? You get this base of liquidity where price previously was efficient, and we run into this void over here, and we pick up liquidity at this area here. You can see that happen right there, right? So understand how price shifts from being efficient, right, and then it will enter a certain state of liquidity which will precede an inefficient move, which is that move over here, right? And look at the state of liquidity. Look at the market just before that event occurred, and in this case, it looked like it was a news event, but the liquidity in the market dries up and creates an environment for this inefficient move. And yeah, this is the key to delivery. Look at the finer details in price. When price is range bound, when price is leaving very little arrays. Look how on the 4-hour chart, look how we were leaving behind very little arrays, right? We get 2 arrays in this whole time period, which is this imbalance here and this imbalance here, which don't take out any areas of significant structure, right? But then when we tap into this region here and we pick up liquidity and we shift into inefficient delivery, look how we create this imbalance over here. And then we tap into this, we pick up liquidity and we go into an inefficient state again, right? Where we're consuming all the available liquidity at local prices and we have to start seeking liquidity. Look how arrays get created in quick succession, right? Look how we get order block imbalance very quickly, right? So you need to start paying attention to the state of delivery and understanding what this means for price. So I'm going to wrap it up there, guys. I feel like I've provided more than enough information for you to take away and start researching, and I will see you in the next video.